The Federal Reserve's latest decision, announced on Wednesday, marked the third consecutive time that the central bank opted to keep its key interest rate unchanged. This decision comes amidst a backdrop of easing inflation and a resilient economy. The policymakers on the Federal Open Market Committee, FOMC, voted unanimously to maintain the benchmark overnight borrowing rate within a targeted range of 5.25% to 5.5%. Contrary to some market expectations, the committee chose to stay on hold, but what caught the attention of observers was the forward guidance indicating a potential series of rate cuts in 2024. The committee members, in a somewhat surprising move, penciled in at least 3 rate cuts for the upcoming year, assuming quarter percentage point increments. This projection was slightly less aggressive than market pricing, which had anticipated 4 cuts, but more robust than previous indications from officials. The impact on the financial markets was immediate, with the Dow Jones Industrial Average surging more than 300 points following the announcement, potentially setting the stage for a record close. This decision to maintain the interest rate comes after a series of 11 hikes, pushing the Fed funds rate to its highest level in over 22 years. The committee's dot plot, which reflects individual members' expectations, suggests the possibility of an additional 4 rate cuts in 2025, totaling a full percentage point reduction. Further, 3 more reductions in 2026 could potentially take the Fed funds rate down to a range between 2% to 5%. Although there's considerable dispersion in estimates for the final 2 years, this projection hints at a potential shift away from a tightening policy stance. In a notable change from previous statements, the committee emphasized that it would consider multiple factors for any further policy tightening, a term that had not been explicitly used before. This could be interpreted as a signal that the era of interest rate hikes might be coming to an end. It's worth noting that, in addition to interest rate hikes, the Fed has been allowing up to $95 billion a month in proceeds from maturing bonds to roll off its balance sheet. Despite the decision to keep rates steady, there is no indication that the Fed is considering curtailing this aspect of policy tightening. The committee acknowledged the current state of prices as elevated, but anticipates core inflation to decrease to 3.2% in 2023.